The most expensive tax mistake many retirees will ever make is not underpaying the IRS. It is paying the IRS too early. That sentence makes people uncomfortable because they have been trained to think about taxes like thunderstorms. The storm is coming, rates will rise, Washington will come for you, required distributions will crush you, Medicare premiums will explode, Social Security will become taxable, your heirs will be trapped. Therefore, act now, convert now, prepay now, move the money now, do something dramatic now. Before the window closes, that is the sales pitch. It is also one of the most overprescribed pieces of retirement advice in America. I do not say Roth conversions are useless. They are not. A sharp knife is not useless. A scalpel is not useless. But when you hand a scalpel to everybody in the waiting room and announce that all of them need surgery, you are not practicing medicine anymore. You are practicing theater. That is the line I want you to keep all the way through this story. A Roth conversion is not free money. It is prepaid tax. That is the mother line for everything I am going to say. Not a loophole, not a magic shield, not an all-purpose retirement miracle. Prepaid tax. And once you understand that, most of the noise around Roth conversions begins collapsing into a much simpler question. Are you paying a tax today that will actually save you a larger tax tomorrow? That is the only serious question. Everything else is decoration. Most people never frame it that way. They hear tax-free growth and stop thinking. They hear no required minimum distributions in the Roth account and stop thinking. They hear taxes might go up and stop thinking. They hear you should fill up your brackets and stop thinking. They hear you do not want to leave your family with a tax bomb and stop thinking. But the tax code does not reward slogans. It rewards arithmetic. And the arithmetic is not flattering to the broad conversion hype. The source document states this very clearly. Roth conversions can be valuable, but only for a very small minority of retirees. For most people, certainly most ordinary retirees. The conversion advice being blasted at them is not built for their situation at all. It is built from a fear story first and a planning story. Second, fay felicite fay turn 50, file 0 fay, that distinction matters. Because fear creates urgency, and urgency is very profitable for people selling sophisticated sounding solutions. I have spent enough time around financial products, tax ideas, estate planning structures, and advisory businesses to know a simple truth. A strategy that sounds advanced, uses official vocabulary, and warns of future pain will usually spread much faster than a quieter strategy built on patience, restraint, and refusing unnecessary moves. People love action. They especially love action that flatters them as prudent and forward-thinking. I am paying taxes now to avoid taxes later sounds like wisdom. In the wrong case, it is just self-inflicted overpayment wrapped in retirement language. That is the first rule. A Roth conversion only makes sense when today's pain is truly cheaper than tomorrow. Pain, that sounds obvious, yet almost nobody begins there. They begin with general fear. Taxes might go up. Congress is unpredictable. RMDs could be a problem. Widow penalties exist. IRMA exists. Social Security may be taxable, all true, all incomplete. Because every one of those fears still has to pass through your actual numbers. That is where the whole story changes. The source lays out the cleanest framework in the file through 3 wealth tiers, and I think that is exactly the right starting point because the first thing most advice ignores is scale. A person with $200,000 in retirement assets is not facing the same future problem as a person with $2 million, and neither of them lives inside the same reality as someone with $8 million. Treating them the same is not planning, it is sales. Let us start with the first group under $500,000 of total assets. This is the vast majority of normal people. The people for whom retirement is not some abstract optimization problem, but a finite pile of resources stretched across an unknown number of years. For this group, Roth conversions are rarely meaningfully helpful. That word matters, meaningfully. It is not enough for a conversion to sound elegant. It must create real lifetime benefit after all taxes. Interactions and trade-offs are considered for most people in this first tier. It does not Fay file cite Fay turn 50 file 0. Fay why? Because the future tax problem they are being warned about is usually much smaller than the current tax they are being urged to trigger. Take the simplest version, a retiree with a modest traditional account balance. Required distributions later in life might be annoying, yes, but annoying is not the same thing as crushing. If $100,000 in a traditional retirement account produces roughly a $4,000 required distribution in the mid-70s, and that future distribution is likely to fall into a lower bracket than the conversion income would create today, then what exactly is being accomplished by converting? You are paying more now to avoid less later. That is not sophisticated planning. That is negative arithmetic. The source says this plainly for smaller retirement balances. Many future distributions may only be taxed around 10 to 12%, while conversions often get pushed through at higher current marginal rates. Pay 22% now to avoid 10 or 12 later. That is not optimization. That is volunteer taxation. Fay file cite Fay turn 50 file 0 Fay. I call this the bracket inversion. The bracket inversion is when a retiree is persuaded to convert at a higher current tax rate in order to avoid future withdrawals that would likely have been taxed at a lower rate. That single mistake destroys an astonishing amount of conversion logic. And it happens because people are shown a future tax ghost without being shown the actual bracket math. Now, the source does note a narrow exception for this lower asset group. If someone has unusually high guaranteed income, perhaps strong pensions stacked on top of Social Security, enough that retirement income may actually exceed pre-retirement income, then the conversion question can become real. But notice how narrow that is. The simple test in the source is whether guaranteed retirement income is expected to exceed pre-retirement income. For most people in this lower tier, the answer is no. And if the answer is no, the conversion conversation mostly dies right there. Fay file cite Fay turn 50 file 0 Fay that matters because it immediately eliminates the vast majority of ordinary retirees from the hype machine. The second rule is this. If your future tax problem is modest, prepaying taxes is usually not strategy. It is surrender. Now let us move to the second tier, $500,000 to $5 million. This is where the noise becomes loudest and the mistakes become most expensive because this is where most affluent, but not ultra-wealthy retirees live. Enough money to attract advisory marketing, enough complexity to be nervous, enough assets that tax planning feels serious, not enough assets that every advanced strategy automatically makes sense. This is where blanket Roth conversion advice does the most damage, because these retirees can benefit under very specific conditions, but only under very specific conditions. The source is right to emphasize how narrow those conditions are. Fay file cite Fay turn 50 file 0 Fay. This is the zone where people most often hear convert now as a catch. All solution. That is dangerous, because the middle tier is not a universal conversion tier. It is a needle threading tier. The source identifies 3 specific conditions worth taking seriously. The first is a gap period after work stops, but before Social Security or pensions begin, when living expenses can be covered from after-tax money without damaging life quality. That gap can create a temporary low-income valley where filling lower brackets with strategic conversions may make sense. The second is the ability to pay the conversion tax with after-tax money rather than with retirement money. That matters enormously because using IRA money to pay the tax often damages the very math that was supposed to justify the move. The third is preparation for specific known tax disadvantages, such as widow or widower filing, status compression or meaningful Medicare or MA pressure once required minimum distributions begin. Fay file cite Fay turn 50 file 0 Fay. Look at how narrow this is. You need the right timing. You need the right funding source for the tax. You need a real future tax disadvantage, not just generalized fear. That is not a universal strategy. That is a surgical case. I call this the gap window conversion. The gap window conversion is a Roth conversion that only becomes attractive because a retiree temporarily has unusually low taxable income, outside cash to pay the tax, and a clear future reason to expect materially worse tax treatment later. That is a very different thing from the way conversions are sold to the public. Most people are not sitting in the ideal gap window. Most people do not have abundant outside cash to pay the tax cleanly. Most people are not actually facing a truly brutal future tax problem. They are facing uncertainty, which is not the same thing. And uncertainty is exactly where bad advice hides, because might get worse someday is one of the easiest emotional buttons to push in a retiree. It sounds prudent, it sounds protective, it sounds like the kind of thing a responsible person should do. But unless the gap window conditions are truly present, the conversion math can quickly turn from elegant to stupid. This brings me to the third tier over $5 million. Here the story changes. The source is right again. At this level, conversions begin making more consistent sense because the retirees already live in a different weather system. They are more likely to be pushed into high brackets by investment income alone. They are more likely to face large required distributions later. They are more likely to have substantial cash outside retirement accounts to pay conversion taxes without damaging the move, and they are more likely to be thinking in both personal tax and estate. Planning terms at once. Fay-Felicite Fay-Turn 50 File 0 Fay. That is a different problem set. Money is no longer the main constraint. Tax exposure is. So yes, in this upper tier, Roth conversions often become more rational. But that is exactly the point. Advice designed for people with $8 million is constantly being broadcast to people with $300,000 and a pension. That is not care. That is category failure. The third rule is this. Tax strategies designed for the wealthy often become expensive fantasies when applied to everyone else. Now let me show you where the math gets nastier than even smart people expect tax interactions. This is where conversion enthusiasm goes to die if somebody actually does the work. The source lists several of these interaction traps, and every one of them matters. Conversions can make Social Security benefits more taxable. They can push capital gains out of the 0% band and into the 15% band. They can trigger Medicare or MA surcharges. They can eliminate or reduce Affordable Care Act subsidies. They can create hidden penalties for people under 59.5 who withhold taxes from the conversion amount itself, because that withholding can count as an early distribution subject to a 10% penalty, and they can fail entirely if the post-conversion investment strategy is not handled well. Fay-Felicite Fay-Turn 50 File 0 Fay. This is what I call the interaction tax. The interaction tax is the extra cost created when a Roth conversion changes other parts of your financial life in ways that standard headline advice ignores. This is why general Roth conversion talk is so dangerous. It treats the conversion as if it occurs inside a vacuum. Move money from one bucket to another. Pay tax. Now, avoid tax later, done. But that is not how real tax returns behave. Real tax returns are ecosystems. Tug one line and 4 other lines move. Your ordinary income changes. Your provisional income changes. The taxable share of benefits changes. Your Medicare income picture changes. Your subsidies change. Your capital gains treatment changes. And if you do not model the whole ecosystem, the supposedly smart move can detonate half the things you were not thinking about. That is why the fourth rule is this. A Roth conversion is not one tax event. It is a chain reaction. People miss this because they are usually focused on the most visible line item. How much tax do I owe on the conversion? That is the wrong question. The better question is, what else did this conversion wake up? That is how adults think about taxes. Now let us speak about fear, because fear is doing a great deal of work in this entire category. The source goes straight at the most popular fear story. Tax rates are about to explode, and if you do not convert now, you will regret it forever. I think the source is right to be skeptical. The broad tax doom narrative is weaker than its sales force admits. The tax environment that many conversion sales pitches were built around assumed automatic expiration of lower tax rates. But the source argues that much of that fear is outdated because recent policy developments made lower rates and deductions more durable then the conversion hype still pretends. It also points to polling showing that the public already believes it pays enough taxes and broadly opposes tax increases on itself, even while supporting higher taxes on corporations and the wealthy. That does not guarantee future rates never rise, but it does weaken the cartoon version of the tax apocalypse being marketed to ordinary retirees. Fay-Felicite Fay-Turn 50, File 0 Fay-I call this the phantom bracket fear. The phantom bracket fear is the exaggerated belief that ordinary retirees are very likely to face dramatically higher future tax rates, even when the political and income realities do not strongly support that claim. That fear matters because it is enough to flip the decision-making frame from arithmetic to emotion. Once emotion is in the driver's seat, prepaying tax starts to feel safe. But safe is not the same as profitable. And profitable is not even the right word here. What you really want is efficient. You want the lifetime tax bill plus all related interaction costs to be lower, not the emotional temperature in your chest to feel lower because you did something. That is a huge difference. Now let me talk about the widow problem, because this is one of the few fear stories that often is real. Married couples filing jointly enjoy wider brackets. When one spouse dies, the survivor often finds himself or herself inside a much tighter bracket system while still living on a not dramatically reduced income. That compression can make later taxes uglier. And this is one of the most legitimate reasons to model partial conversions during the years when both spouses are alive and filing jointly. The source correctly includes this as one of the specific future disadvantages worth planning around. Fay-Felicite Fay-Turn 50, File 0. Fay, this is an example of a real tax cliff, not a phantom one. But again, even here, notice the logic, a specific known disadvantage, a modelable problem, a real reason. Not panic, not blanket rules. That is how I want you thinking about all of this. Now let us talk about IRMAA. People speak about IRMAA as though it is some obscure Medicare footnote. It is not obscure if it hits you. IRMAA is one of the cleanest examples of sideways tax pain in all of retirement planning. Your Medicare premiums rise because your modified adjusted gross income rose enough to cross the relevant thresholds. A Roth conversion can be the thing that pushes you there. That does not automatically mean the conversion was wrong, but it does mean the conversion math was incomplete if IRMAA was not included. The source is exactly right. On this point, these interactions are often what wipe out the apparent benefit of the conversion. Fay-Felicite Fay-Turn 50 File 0 Fay-I call this the premium ambush. The premium ambush is the extra cost imposed through Medicare surcharges when a Roth conversion inflates income enough to trip IRMAA thresholds and make your supposedly smart tax move more expensive than advertised. This is one reason I get annoyed with one size fits. All planning language, it leaves landmines out of the conversation and then acts impressed with itself for sounding proactive. Real planning is not proactive because it sounds urgent. It is proactive because it is specific. Which brings me to one of my favorite parts of the source, the 6 costly mistakes. These are not just mistakes. They are windows into how lazy planning behaves. Incomplete analysis short. Term focus, ignoring interactions, early distribution penalties, poor post-conversion investing, converting when inappropriate for the asset size and future withdrawal profile. Fay-Felicite Fay-Turn 50 File 0 Fay. Every one of these mistakes comes from the same deeper disease, failure to think in lifetime systems. That is what I care about most. A Roth conversion is not about winning this year. It is about reducing the total long-run burden across your actual life, your spouse's actual life, and in some cases your heirs' lives. If you win this year as tax optics but lose across the next 15 years because you triggered unnecessary tax. More taxable Social Security, higher Medicare costs, and lower flexibility. You did not plan, you performed. That is the 5th rule. A Roth conversion should be judged over the whole lifetime, not over the emotional satisfaction of the current year. Now let us address the part of the source that many people will politely ignore, because It is impolite to say out loud advisor incentives. The source argues that Roth conversion advice is a very effective business tool for advisors. I think that is an important observation. A strategy that sounds advanced, addresses fear, feels time-sensitive, and often leads to ongoing management is naturally attractive from a business perspective. That does not mean every advisor recommending a conversion is self-serving. Far from it. But it does mean you should be very careful when you hear blanket urgency, generalized fear, and no real wealth. Tier analysis behind the recommendation. The source lists the warning signs well: convert now language, generic tax, rate fear, cash flow assumptions that ignore how you will actually pay the tax, and advice that treats every retiree as though the same playbook applies. Fay file a site, Fay turn 50, file 0, Fay I. Call this the sophistication premium. The sophistication premium is the extra trust and urgency generated by advice that sounds advanced and protective, allowing advisors to sell or reinforce services even when the strategy may not fit the client. Well, again, I am not accusing every planner. I am telling you to respect incentives. A tool can be real. A business incentive can also be real. Those two things can exist together. This is why the source S final process is so useful. Identify your wealth tier honestly. Review whether you actually meet the relevant criteria. Model all interactions. Calculate the break. Even point, confirm you have outside cash to pay the tax. And only then decide whether the conversion deserves a place in your plan. Fay file a site, Fay turn 50, file 0, Fay that has grown. Upwork, it is not sexy, it is not viral. It does not lend itself to dramatic thumbnails about tax doom. It is just reality. And reality is where money gets kept. Now, let me say something that may irritate people who love broad financial slogans for most retirees. The best Roth conversion may be no Roth conversion, not because the Roth is bad, because unnecessary tax prepayment is bad, if your assets are modest, if your future required distributions are likely to be small, if your retirement bracket is not likely to exceed your current bracket, if you do not have strong outside cash, if you are not sitting in a clean gap year, if you are not dealing with a real widow problem or an outsized Ermaya issue, then the most intelligent move may simply be to leave the money where it is and stop letting fear. Based content rents space in your head. That is not passivity. That is selectivity. And selectivity is what serious people practice when the world keeps trying to sell them action. Now let me pull all of this into the real identity shift in the story. Most retirees are being trained to think like tax warriors. I want you to think like lifetime tax allocators. That is the flip. A worrier hears rates could rise and reaches for a dramatic move. An allocator asks, relative to my actual future withdrawals, my actual brackets, my actual cash reserves, my actual Social Security, my actual Medicare exposure, and my actual life expectancy. What does this really buy me? That is a much better way to think. A worrier sees a Roth conversion as a moral act of prudence. An allocator sees it as a tax prepayment contract that must justify itself against every realistic future scenario. A worrier wants certainty now. An allocator wants lower lifetime drag. That is what I care about. Lower lifetime drag, not slogans, not tax fear. Not the emotional thrill of doing something that sounds smart. The real question is, and always was the simplest one, are you paying taxes early to save more later, or are you paying taxes early because somebody frightened you into a move that flatters them more than it helps you? That is the whole issue. And if you keep that question in front of you, most of the noise fades for a very small percentage of people. Roth conversions are powerful for a much larger percentage. They are unnecessary. For a huge number, they are actively harmful when done lazily. That is not anti-Roth, that is pro-math. That is the only position worth having here. So if I were to leave you with one final sentence, it would be this: a Roth conversion is not a default. It is a bet. And before you place any bet, you had better be very sure you know the odds.